Bank profits crash by over 40%. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I'd like to have a look at an article from the Financial Review discussing the ANZ full year profits and how it's plunged by 42%. So they're still in profit at 3.76 billion, but they've taken a 42% slice. Now, let's jump over and see how their share price is doing. At the moment, we're sitting at $18.82. If we go out to 6 months, yeah, it's not too bad. Let's go out to a year. You know, they're still down from the peak. From the 52 weeks, it was at $27.93. Their 52-week low was at $14.10. So they've recovered a little bit from there, and they've gone a bit down since this news appeared. Now, their dividend yield is 5.58%. We'll have to see how that goes with what dividends they can pay. So, ANZ Bank full-year profit plunges 42% to 3.76 billion. ANZ Bank said cash profits had plunged 42% to 3.76 billion for the year to September 31 as the pandemic caused it to ramp up provisions against loans which could go bad as borrowers struggle to recover from the impact of the virus. The bank has made a credit impairment charge of 2.74 billion before tax for the full year, 2 billion higher than the level a year ago, to provide a buffer if pandemic losses materialize. The bank still has 61,000 deferred home loans across Australia and New Zealand, down from 108,000 as of July 31, with another 10,000 frozen business loans down from the peak of 23,000. Well, that's good that the business loans are dropping down. Bell Potter analyst T.S. Lim said the numbers were in line with expectations and continually improving deferral numbers and strong common equity tier 1 of 11.3%, noting the fully franked dividend of 35 cents a share was a pleasant outcome given the volatile economy. It won't shoot the lights out, but it's a solid result in turbulent times, Mr. Lim said. UBS analyst Jonathan Mott concurred, describing the high CET1 levels, the bank's shock absorbers for bad debt, as a solid bet. Reasonable result with a lot of moving parts. Strong capital, provision built, and runoff of deferrals were the highlight, Mr. Mott said. Despite the positive response from analysts, ANZ shares were sold off heavily at the open, following falls on Wall Street overnight. At 11:30 a.m., ANZ shares were 2.8% lower, or hit around twice as hard as NAB and Westpac, which were down 1.6 and 1.5. The total provision for the second half was 1.1 billion, lower than the 1.67 billion raised at the first half, as the economy starts to recover from the crisis. Its strong balance sheet has allowed ANZ to distribute some profits to shareholders. It will pay a final dividend of 35 cents per share, fully franked with no discount for its dividend reinvestment program, after it paid a 25-cent interim dividend in May. Analysts had been expecting a slightly higher payout before the bank announced additional write-downs earlier this week, with APRA's edict to limit dividends to no more than 50% of profits still in place. While our immediate focus has been on assisting customers, we have to take steps to protect the interests of our shareholders by maintaining a strong capital position, tightly managing costs and bolstering credit reserves while still managing to pay a prudent dividend without diluting their holdings, ANZ CEO Shane Elliott said. The net interest margin, a key revenue driver, shrank to 1.63% from 1.75% as low official interest rates squeezed the gap between interest paid out on deposits and earned from loans in a competitive market. ANZ Chief Financial Officer Michelle Jabloko said the lower overnight cash rate was quite a big factor in the results. ANZ said home loan growth in owner-occupiers was above the market average or system, and deposits remained strong as conservative customers decided to save more. Well, everyone decided to save more. A saving rate is at the highest it's ever been. People are worried. People are concerned. We're entering a recession. Or we're in a recession, even though some people seem to argue that it's over. Its home loan portfolio grew from 264 billion at the end of March to 275 billion at the end of September, lifting its mortgage market share from 14.1% to 14.4%. But commercial lending volumes were flat, with borrowers remaining cautious, and personal loans and credit card lending was also down. Institutional customers also paid down facilities ANZ had provided in the first half of the virus arrived. Investment spending was much higher, raising to $1.77 billion from $1.4 billion a year earlier, as the bank invests in its systems and data, which Mr. Elliott said was helping it manage credit risk. Return on equity sank to 6.2% from 10.9% a year ago. Expenses were flat at $8.6 billion. The total number of full-time equivalent staff was down 1% to 38,579 from 39,060. The bank hired to deal with the COVID, but property costs fell as its workforce withdrew to their homes. The Common Equity Tier 1 capital ratio, the key measure of strength, was 11.3%, just 0.1% points down over the year, which outgoing chairman David Gonski, who retired from the role on Wednesday, said was a highlight for the board. Evans & Partners analyst Matthew Wilson said the result was largely as expected, and the ANZ is pulling all the levers at its disposal to protect earnings in COVID-19 environment. No question about the supply of credit, it's all about demand, Mr. Wilson said. Swamped by RBA liquidity and hamstrung by a very low interest rate and a flat yield curve, ANZ is doing its best to control what it can, costs and non-interest income. So deferred loans. ANZ warned investors the ongoing pandemic had increased the estimation uncertainty in its financial systems. The ramifications of COVID-19 continue to be uncertain, and it remains difficult to predict the impact or duration of the pandemic, the bank said. The results provided fresh details on the critical issue of deferred loans, with around 95,000 of its 1 million home loan customers being granted a deferral at the peak. The quantum of frozen loans continued to roll off and was down 10% month to month. ANZ's head of retail banking, Mark Hand, said the bank was having the same problem as some other banks, where customers on deferral were giving them silent treatment or ghosting them, which had already affected as many as 1 in 5 frozen loans. We haven't had a big issue with ghosting. So certainly customers that you call don't answer the phone the first time you call. They've got a lot of other things on in their lives. But what we are finding is you email customers, you write to them, you call them, some proactively call us, but for us it's only about 3% of customers that they were trying to get in touch with. ANZ said in October 15 there were 55,000 accounts with 6 months deferrals had been completed. Of these, 79% are returning to full payment, 20% had requested a further deferral, and 1% had restructured their loans or sought additional support. Of the remaining deferrals still active, ANZ said half had at least a 3-month payment or greater savings buffer, and a quarter had made at least 1 payment while on deferral. Of the 23,000 deferral business loan repayments, ANZ said 15,000 are completed as at the October 15, and of these 1,600 received a 4-month extension, and 60% of those were from Victoria. The results come after ANZ on Tuesday pointed to rising customer refunds as the remediation bill almost doubled, declining value of its software and a write-down of goodwill as factors hitting its cash profit by $528 million. The additional remediation costs have taken the bank's total spending on program costs and refunding customers to $1.59 billion since 2017, as ANZ and other banks headed into a royal commission. Analysts were surprised this week at the extent of ANZ's additional remediation costs. Pointing to ANZ's stable management, a strong balance sheet, and prudent credit reserves, Mr. Elliott, the bank would be able to support customers and protect their long-term interests of shareholders. While we're not managing the business expecting things to return to the way they were before the pandemic, nor are we sitting idle waiting for the next event to happen. ANZ is well placed to respond to the opportunities that are emerging as a result of accelerated structural shifts in the economy, he said. ANZ shares closed Wednesday at 19.16, their highest level since June, and up 35% since the market in mid-March. So we can see, profits were hit at ANZ, and this isn't the only one. Westpac also warned that their 2H20 profits are reduced, or the cash earnings are reduced by $1,220 million after tax. So you can see Westpac are copping it, ANZ have copped it, and we'll have to see what happens for the other banks when their profits and revenue gets issued. As always, let me know your thoughts and opinions in the comments down below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you next time.